America's recurring economic crisis exposes a strange contradiction. A nation that prints the world's reserve currency yet repeatedly flirts with default. The debt ceiling, meant to enforce discipline, instead fuels instability, politicizes solvency, and reveals an infinite ledger sustained by confidence, power, and postponed reckoning in modern American governance today. Imagine a clock that never stops ticking, yet its face has no numbers, only a rising sequence of zeros. This is the American national debt, a figure so vast it defies human comprehension, currently accelerating past $34 trillion. For decades, the debt ceiling has been presented to the public as a rigid barrier, a final line of defense for fiscal sanity. Yet, every few years, the world watches a familiar political theater in Washington, D.C., where the ceiling is raised just as the floor begins to fall away. We are living inside a paradox, an infinite ledger where the world's most powerful economy spends money it does not have, backed by a promise that it will never default. But beneath the calm surface of high-end consumerism and soaring stock indices, a fundamental question lingers. What happens when the global appetite for American debt finally reaches its limit? The tension is no longer about a political stalemate. It is about the structural integrity of the global financial architecture. As the cost of servicing this debt begins to rival the entire defense budget, the margin for error disappears. The ledger is screaming, and the silence from the halls of power is the loudest warning we have ever received. We are moving toward a tipping point where the physics of finance may finally override the will of the state. The cracks in the ledger are beginning to manifest through a series of unprecedented economic signals. Historically, US Treasury bonds were considered the risk-free asset of the global system. But recently, the cost of insuring that debt via credit default swaps, CDS, has seen unsettling volatility. This suggests that even the most institutionalized players are pricing in the possibility of a systemic shock. Liquidity in the bond market, the ease with which trillions of dollars can be moved without causing price swings, has begun to thin, creating a dangerous fragility. When the Treasury market stutters, the ripple effect hits everything from mortgage rates to the value of the dollar. We see the impact in the real estate sector, where surging interest rates designed to cool inflation are simultaneously making the cost of government borrowing unsustainable. The exchange rate of the dollar remains high, yet this strength is deceptive. It masks a growing global anxiety about the long-term viability of a debt-to-GDP ratio that continues to climb into uncharted territory. For the average observer, these indicators may seem like abstract data points, but they are actually the tremors felt before a tectonic shift. The system is signaling that the era of free money is over, and the transition to a new reality will be neither quiet nor painless. The mechanisms of these economic shocks are rooted in the feedback loop between interest rates and debt service. As the Federal Reserve raises rates to stabilize prices, the interest expense on the national debt explodes. This forces the government to borrow even more just to pay the interest on what it already owes, a classic debt trap. This creates a crowding out effect where private investment is stifled because capital is sucked into the black hole of government financing. When the market perceives that the debt is growing faster than the economy's ability to produce, a liquidity squeeze occurs. Suddenly, the very institutions that provide credit to businesses and homeowners become defensive. This is where the shock turns systemic. A sudden spike in yields can trigger a wave of defaults in the corporate sector, which is also heavily leveraged. Unlike the 2008 crisis, which was centered on subprime mortgages, the next shock could be centered on the sovereign debt itself. If the primary dealer system for treasuries fails to absorb the supply, the central bank is forced to become the buyer of last resort, essentially printing money to fund the government. This mechanism, while preventing a nominal default, risks triggering a currency crisis that devalues the life savings of every citizen, transforming a financial problem into a social catastrophe. We do not have to guess what happens when the ledger fails. History and global case studies offer a haunting preview. the 1997 Asian financial crisis showed how a sudden withdrawal of confidence can evaporate liquidity in hours, forcing the IMF to intervene with harsh austerity measures that crippled nations like South Korea and Thailand. In more recent decades, we have seen the tragic trajectory of Argentina and Venezuela, where the inability to manage sovereign debt led to hyperinflation and the total collapse of the middle class. Turkey's recent struggles with exchange rates illustrate how a refusal to align interest rates with economic reality can trap a nation in a cycle of poverty. Even within the developed world, Greece's 2010 debt crisis proved that no modern state is immune to the laws of mathematics. These nations all shared a common trait. They reached a point where the cost of borrowing exceeded the trust of the lenders. The US is unique because it prints the world's reserve currency, but this exorbitant privilege is not a shield against gravity. If the dollar's status is compromised by the paradox of infinite debt, the US could find itself facing the same IMF-style restructuring it once imposed on others. The lesson from these global cases is clear. When the math fails, the social order follows closely behind. The impact on the American economy and the daily lives of its citizens is already becoming visible through the erosion of purchasing power. As the government competes for capital, interest rates for consumer loans, credit cards, and mortgages remain elevated, effectively locking a generation out of homeownership. This is the debt ceiling tax, a hidden cost paid by every worker whose wages cannot keep pace with the rising cost of living. In this environment, the gap between asset owners and wage earners widens dramatically. Those who own real estate or stocks can see their values inflated by the sea of liquidity, while the worker sees their disposable income swallowed by the rising cost of debt. We are seeing a hollowing out of the American dream, where the sense of upward mobility is replaced by a desperate scramble to stay afloat. Small businesses, the engine of US employment, find it increasingly difficult to secure the credit needed for expansion, leading to a stagnant labor market. The tension is felt at the grocery store and the gas pump, where price volatility is a direct reflection of the underlying instability of the currency. The infinite ledger is not just a government problem. It is a weight that every American carries in their pocket. When the sovereign's credit is questioned, the value of the individual's labor is the first thing to be discounted. Government and central bank responses have historically relied on a policy of extend and pretend. When a crisis looms, the Federal Reserve often pivots to quantitative easing QE, buying up government debt to keep interest rates artificially low and provide liquidity to the markets. While this prevents an immediate collapse, it further complicates the ledger. By inflating the Fed's balance sheet, the central bank essentially devalues the currency to save the banking system. This response creates a moral hazard, where politicians are never forced to make the difficult choices of fiscal discipline because the central bank acts as a safety net. However, we are reaching the limits of this strategy. With inflation persistently higher than the previous decade, the Fed can no longer print money without risking a total loss of confidence in the dollar's exchange rate. Legislative responses often focus on temporary band-aids or continuing resolutions that push the problem into the next fiscal year. There is growing talk of radical measures, such as a $1 trillion coin or central bank digital currencies, CBDCs, which would give the government more direct control over the flow of money. Yet, these are technical fixes for a fundamental problem of overspending. The ultimate response must eventually be a painful choice between massive tax increases, deep spending cuts, or allowing inflation to burn away the value of the debt, all of which carry immense political and social risks. Navigating this infinite ledger requires a shift from passive saving to active capital preservation. Personal survival strategies in a debt-burdened economy begin with the elimination of high-interest consumer debt. In a systemic shock, credit can be withdrawn instantly, leaving those with variable rate loans highly vulnerable. Diversification is no longer just about choosing different stocks. It is about diversifying across asset classes and even jurisdictions. Investors are increasingly looking toward hard assets, commodities like gold, silver, and even productive land, which have intrinsic value that cannot be inflated away by a central bank. Maintaining a liquidity reserve of cash outside of the traditional digital banking system can provide a vital buffer if the repo markets freeze or bank holidays are declared. Additionally, understanding the global exchange rate environment is crucial. Holding assets in different currencies or even decentralized digital assets can hedge against a localized dollar crisis. For the average worker, the most important survival strategy is the inflation of skill. Investing in specialized knowledge and transferable skills ensures that your labor remains in demand, even if the currency it is paid in loses value. The goal is to become as independent of the centralized credit system as possible, ensuring that your family's stability is not tied to the political theater of the debt ceiling. The most remarkable aspect of the debt ceiling paradox is how it forces us to reconsider the very nature of money. For most of human history, money was a tangible commodity with a limit. Today, it is a digital entry on a ledger that can be expanded at the stroke of a key. This shift has allowed for unprecedented growth, but it has also removed the natural brakes that prevent a civilization from overextending itself. The infinite ledger is a grand experiment that has never been successfully concluded in the history of finance. When a nation's debt becomes its primary export, the relationship between the state and its citizens changes. The state no longer serves as a protector of value, but as a manager of a slow-motion default. This realization is unsettling, but it is also the beginning of financial wisdom. We are seeing a global movement toward de-dollarization, as other nations begin to fear that the American ledger is no longer sustainable. This isn't just a challenge to US hegemony, it is a challenge to the entire global trade system that relies on a stable dollar. The remarkable truth is that the system only functions as long as everyone agrees to ignore the math. The moment that collective agreement ends, the paradox resolves itself through a reset. Whether that reset is orderly or chaotic depends entirely on how much truth we are willing to face before the clock finally hits zero. As we move toward the final chapters of this fiscal era, we must recognize that the debt ceiling is not a fiscal tool, but a psychological one. It exists to give the illusion of control over a system that has long since outgrown its boundaries. The true danger is not a single day of default, but the slow rot of a currency that loses its function as a store of value. We are witnessing a transition where the US dollar may remain the cleanest shirt in the dirty laundry of global currencies, yet still fail to provide the stability the world needs. This transition will likely be characterized by financial repression, a period where interest rates are kept below inflation, effectively transferring wealth from savers to the government to pay down the debt. For the viewer, the insight is that you cannot rely on the institutions of the past to protect your future. The traditional 60/40 portfolio may be a relic of a bygone era of low debt and high growth. The new era requires a more skeptical view of government promises and a more robust approach to self-reliance. Watch the actions of central banks who are currently buying gold at record rates rather than their words. They are preparing for a world where the ledger is no longer infinite. By aligning your personal strategy with the moves of the smart money, you can find a path through the paradox and emerge on the other side with your prosperity intact. We conclude this investigation into the American ledger with a simple but profound realization. The debt is a reflection of our collective choices. It represents the roads we built, the wars we fought, and the social safety nets we promised, all without deciding how to pay for them. The paradox of the debt ceiling is ultimately a mirror held up to a society that wants everything today and is willing to charge it to a tomorrow that may never arrive. But tomorrow is finally knocking on the door. The trillions of dollars in debt are not just numbers. They are a claim on the future labor and the future freedom of every American child. To solve the paradox, we must return to a fundamental honesty about what things cost and what we can actually afford. This is the remarkable message for the viewer. While the system is complex, the laws of economics are eventually unavoidable. Prosperity cannot be printed, it must be produced. As the curtain falls on the era of the infinite ledger, the responsibility for financial sanity shifts from the halls of Congress to the individual. By seeking the truth, diversifying your risks, and valuing productive labor over speculative debt, you can claim your own fiscal sovereignty. The clock is ticking, and the zeros are still rising. But for the informed and the prepared, the end of the paradox is not the end of the world, it is the beginning of a more honest and resilient future.